Singapore-listed REITs ETFs have seen more than 300 million Singapore dollars in net new inflows, reflecting continued investor demand. The combined AUM of these ETFs have surged by 40% over a year, reaching an all-time high of 1.2 billion Singapore dollars by the end of the first half of 2025. This growth in AUM has outpaced the REITs sector's price movements, as reflected by the IHS REITs Index and FTSE EPRA Nareit Index, which reported total returns of 10.5% and 12.5% respectively. Among the top 10 traded ETFs listed in Singapore, the Lion Phillip S REITs ETF and the Nikko AM Straits Trading Asia x Japan REITs ETF stood out, recording the highest net inflows. The Lion Phillip S REITs ETF, Singapore's first and largest ETF focusing on S-REITs, tracks the Morningstar Singapore REITs Yield Focus Index, which includes 21 constituents and boasts an AUM of over 540 million Singapore dollars. As one of the two pure-play Singapore REITs ETFs, it offers a dividend yield of 5.8% and achieved total returns of 4.1% in the first half of 2025. Scan or click the link in the description to learn more about these stocks or join SGX Invest on Telegram for the latest news update. Please note this is a general commentary of historical performance and not necessarily indicative of future performance. Check out our investment courses that are up to 70% subsidized at cyberquote.com/sg or contact us at support@cyberquote.com.sg.
The digital world is ever-changing. With more than 20 years of experience in serving the investing public and the financial services industry, Cybercode has been providing financial training and information technology solutions for established clients. Cybercode is based in Singapore, with 7 offices around the globe and continually expanding. Being ISO 27001 certified and having a proven reputation for service excellence, Cybercode endeavors to build long-term relationships with customers and business partners alike. Our services include, but not limited to, the following: investing public, to provide training programs to the public, such as investment and stock trading courses. Financial professionals, providing up-to-date training courses for the finance professionals, keeping them well-informed with compliance, regulatory requirements, financial products, and best practices. Financial technology. We develop and provide information technology solutions and management services, curated specifically for our clients' needs. Cybersecurity and data. We provide data, information, analytics, and cybersecurity services to your business, keeping your data safe. Since our inception, we have trained thousands of participants among the investing public, financial professionals, hundreds of B2B clients, and have continued to forge strong business partners. To find out more about what we do and how we can help you, contact us today. Cybercode is a leading financial training provider and a leading developer of information technology solutions and management services.
Cyberquote is an ISO 27001 certified financial services training provider, based in Singapore, with a rich 25-year history of establishment. We have provided financial training to people from all walks of life and continue to do so today. Our courses cover a multitude of different financial and investment topics and are designed for even beginners. The courses are IBF accredited and are subsidized for up to 90% for Singaporeans and permanent residents. You may also utilize your skills future credit to fund the training. What are you waiting for? Seize the opportunity and upskill yourself. Head over to cyberquote.com/sg and sign up now. All our courses are hosted online. Check out our free previews in the events tab of our website. Need more info? Drop us an email at support@cyberquote.com.sg. See you soon.
The Institute of Banking and Finance, or IBF, was established to foster and develop the professional competencies of the financial sector. IBF is dedicated to empowering practitioners with capabilities to support the growth of the Asian financial industry. It is the national accreditation and certification agency for financial sector competency. Developed by the industry for the industry, IBF Standards is a set of competency standards benchmarked to international best practices. IBF's vision is to be the Asian standard of excellence for practitioners in finance. IBF Standards covers 13 industry segments and offers a wide range of development roadmaps. IBF Standards offers accredited programs to guide a financial practitioner from licensing examinations to professional certification. IBF Standards certifies financial practitioners at 3 levels. An IBF qualified individual is one who is equipped with a broad base of capabilities and foundational competencies to undertake new roles. An IBF advanced individual is one who has acquired applied knowledge and complex analytical skills for specialists or leadership functions. An IBF fellow is an industry veteran who has demonstrated professional mastery and exemplifies thought leadership and commitment to industry. The IBF certification mark, a set of parallel elevation bars, symbolizes the close partnership between IBF and the industry. IBF certification is therefore an industry-endorsed mark of quality that recognizes individuals who exhibit professional excellence, integrity, and commitment to the industry. Be part of the IBF community of certified financial practitioners. Participate in continuing professional development programs. Avail yourself to learning resources to plan your career. There are also opportunities for mentoring and networking. IBF, the Asian Standard of Excellence for Practitioners in Finance.
The digital world is ever changing. With more than 20 years of experience in serving the investing public and the financial services industry, CyberCode has been providing financial training and information technology solutions for established clients. CyberCode is based in Singapore with 7 offices around the globe and continually expanding. Being ISO 27001 certified and having a proven reputation for service excellence, CyberCode endeavors to build long-term relationships with customers and business partners alike. Our services include, but not limited to, the following: investing public, to provide training programs to the public, such as investment and stock trading courses. Financial professionals, providing up-to-date training courses for the finance professionals, keeping them well informed with compliance, regulatory requirements, financial products, and best practices. Financial technology. We develop and provide information technology solutions and management services, curated specifically for our clients' needs. Cybersecurity and data. We provide data, information, analytics, and cybersecurity services to your business, keeping your data safe. Since our inception, we have trained thousands of participants among the investing public, financial professionals, hundreds of B2B clients, and have continued to forge strong business partners. To find out more about what we do and how we can help you, contact us today. CyberCode is a leading financial training provider and a leading developer of information technology solutions and management services.
Hi, a very good evening, ladies and gentlemen. Thank you for tuning in for this Tuesday webinar session of the webinar titled Mapletree Family of the REITs. Are they good for first-time investors? By our Senior Financial Services Director, Darren Chew, is also the IBF Accredited Trainer who teaching two different courses, Lifetime Income Mastery course as well as REITs Analysis course, which is one of the course that we're going to share with all of you here till the end of session. Sorry. Now, also the associate trainer with CyberCode. Now, allow me to do a short introduction of the company as well as the keynote speaker. Now, thank you very much for those been following through with CyberCode as well. Darren Chew, a Senior Financial Services Director for these years, right? Without you, the support, we are not here. We are not able to be here. So thank you very much for your continued support. Now, of course, for the benefit of those who are new, who just get to know CyberCode, let me just do a short intro of the company. CyberCode, we start off our business since 1996 as the video played earlier on. We start off providing financial investment courses to the retail individual, and of course, for the corporate level B2B, we're providing the cybersecurity courses, IT penetration testing courses, and of late, I think close to 5.5 years back when this COVID hit the whole worldwide. So is Singapore also affected. So during that 5 years plus, so CyberCode also getting one of the highest number of the IBF accredited courses. So in fact, two of the course, I think Darren Chu is the only one within CyberCode who are teaching two different courses. Lifetime Income Mastery course, which is I think easily more than 3,000 over graduate, 3,000 graduate who benefited from this course during the I think easily 4 or 5 years, right? Even before COVID, you already start teaching, as well as the risk analysis course, right? So we are quite fortunate to have a Darren Chiu here to share with all of you here his so-called his talent. Right now, again, yes, of course. Also, let me just touch a little bit of the keynote speaker, Darren himself. Now, indeed, Darren, before he joined Philips Security, he is an engineer born, so and quite a high honor. I think he got a second upper honor in mechanical engineering. So in year 2008, as you can count, right, close to 20 years already. So he is joined Philips Security as a stockbroker, and then from the stockbroker to taking a dual license to promote to a service direct this manager, and then as per Norman, currently who are holding a senior financial services director, who are taking care of more than 40 over financial advisors and trading rep under his care. Now he is also one of the very individual in the market who are pretty not many people can get that. They call top of the table, which is I think he will share with all you later. This is the one of the top accolade awards in Singapore contact. And of course, being so successful because I think Darren using this is the two unique thing that he always share during especially the lifetime income mastery course called personal finance and retirement planning. So indeed, yeah, I think he's one of the very strong individual in the market can provide this sharing how for retail trader how to actually maximize your investment and maximize your personal finance, right? Now again, today is a short 2 hour session, but we want to also share with all of you here. If you do have question throughout the live webinar session pertaining to that topic, you can post a question in the chat or Q&A, right? So as actually for trainer Darren to reply to your questions, right? So stay tight. And stay tuned also to the end of session. Myself and Darren going to share with you one of the IBM accredited courses also. So without much delay, I shall cautiously overpass the mic over to Darren, our senior financial service director, to take over for the session. Right, over to you, Darren.
Thank you, Andy. Hey, good evening, everybody. Thank you for attending today's webinar. Okay, today will be the so-called the last 4 series of the REITs webinar. I'm going to talk for July and August. And today we're going to talk about the Mapletree family of REITs. Before I start, this is the CyberCode multimedia connection. You can connect with CyberCode in any of this format. And this is the disclaimer. What I share with everyone is for your knowledge and information only. It doesn't constitute any financial advice, as everyone's financial situation is also different. So do remember to do your own due diligence before you make any financial decision on that. And also that is not a buy or sell call for tonight's session, whether you should buy or sell the Mapletree REITs on that. Okay, and any other talk about me? Just a fast introduction about me in case some of you miss it or don't know who am I. I'm Darren Chu here. I'm from Philips Securities, and I'm also a trainer for IBF accredited program. As Andy have said, I've conducted 2 IBF course. One is called the Risk Analysis course, and one is called the Lifetime Income Mastery course. But the Lifetime Income Mastery course, I decided to stop it and do it in another form. So then the risk analysis course will still be there. And the risk analysis course, I'll have a run in August. October, most likely will have a second run, but this one I need to discuss Cybercode, whether we go ahead with October run. And I got my YouTube channel where I share live portfolio, but you may, for those that are subscribers for my YouTube channel, you may see that I didn't update because really too busy. I'll try to update my portfolio where I got 3 portfolio. One is the Singapore and US stocks portfolio that focus on income, and one is a unit trust portfolio focus on growth, and one is a SIS portfolio that focus on US market. Okay, and I'm planning on the 4th quarter, maybe I'll share with you another portfolio, my option portfolio that I focus on generating just income, but just by selling put options to generate income. Yeah, I will see how it goes on that. And then I got my Facebook page where you can follow me on my Facebook page. I'll post other webinar that is not linked to Cybercode. And this is a 1-page summary about me. More than 20 years in this industry. And before that, I was an engineer. And I worked as an engineer for 10 years before I crossed over to this industry. So roughly you're able to gauge how old I am. As what Andy mentioned, I'm also a qualified member for the top of the table. There's a higher qualification an advisor can achieve in this industry. So yeah, someone that want to explore and know more about this industry, you can talk to me separately. I can share with you the ups and downs and the good and bad about this industry. And I also have a community, which is a WhatsApp community. As you may notice, some of you may notice there is a lot of quite a number of Darren Chu in the Telegram. And do take note, all Telegram group that we might name there are all scam. Okay, so that's one thing to take note. All Telegram group with my name there are all scam. As I do not have any Telegram group. I do not have any Telegram group, and I also don't communicate with any of my clients on Telegram because too many scammers there, so I just stop completely communicating with anyone. So I only have this group which is on the WhatsApp announcement page and using my personal handphone number. So if you are keen on this, you can just join this. Do take note this group, this WhatsApp mainly for announcement purposes, and you do not provide stock calls, as I don't advocate trading, although I'm a reminder. Okay, and of course this community have grew in size. We even plan to hold quarterly webinars. As you can see, this is a webinar that's just over where last week we talked about dividend growth stocks and pure income investment on that. So that's if you are on our email list, or you may never see this email this market because we only send it in the broadcast group for the chat group. So if you are keen on that, you can just click on the link to join my WhatsApp broadcast group, and we will plan to do at least 1 webinar per quarter. But if the number of people in the community are getting more and more, then we'll do it more frequent. So we'll see how it goes on that. And you also, for those in the community, you got my number, you can also suggest to me what you want to know about in the next exclusive webinar. Okay. So now let's go straight to today's topic, maple trees. We're going to talk about Mapletree REITs. Just some context for those that are new to REITs. This is the REITs that is listed in Singapore. I didn't put in NTT REITs yet. I'm not putting in. Anyway, it's very, very new. So you see, I also don't buy new REITs. So I didn't put in that. If it's in, you'll be under this category. Okay, under the data center REITs. So these are all the REITs that is available in the market. As I mentioned, that when you want to invest in REITs, that's one of key components of buying REITs is looking at the sponsor. You want to have a sponsor that have a skin in the game, and they are powerful, they are strong, and they have a very good alignment of interest with the investor. Okay, so as some sponsor may not be that aligned with the investor, some is very, very aligned. So Mapletree, my personal view is they are very aligned with the investor interest on that, maybe because they are the market. So they have no choice, they have to be aligned in a way. Okay, and these are the three: Mapletree Industrial, Mapletree Logistics, and Mapletree Pan Asia Commercial Trust. So these are where the three Mapletree REITs there. Would there be a four Mapletree REITs? Actually, I'm hoping to have one, and they've been talking for years, but up to now still never come out yet. It's more focused to a student accommodation. Okay, but I think because of COVID come, all this, I think there is in the end no news up to today. So will it come or not? We don't know. Okay, so these are the three Mapletree REITs. So you can see where are they classifying? First thing, they are not on healthcare. Okay, they are not on healthcare. They are not on the healthcare side. They are not on the hospitality side. So these two, they are out. They got data center, they got shopping mall, they got office and commercial building, and of course they got industrial. So that is what the three Mapletree cover. They do not have hospitality and healthcare, but the rest of the sector they have a portion on it. So this is what the Mapletree REITs are in. And let's look at their performance if you were to buy them during the IPO period and you forgot about you are holding it since IPO on that, and how have they been giving you the returns over the years. So these are the things. So you can see from this chart, the first one to IPO is Mapletree Logistics Trust, with IPO before COVID, way before COVID. At 2005 he had IPO. Then the other two Mapletree is at IPO is Mapletree Industrial Trust and Mapletree North Asia Commercial Trust. And some background, Mapletree North Asia Commercial Trust is a merger between Mapletree North Asia, and Mapletree Pan Asia, North Asia, and Mapletree Commercial Trust. So now it's called Mapletree Pan Asia Commercial Trust. So they are IPO after COVID is 2011. So imagine this is including dividend. Imagine you have to buy them since IPO until and hold it until today. This is the return you get. So the top performance is Mapletree Logistics Trust, which is M44U. In case some of you don't know what's a ticker code, it will generate you a 372% returns. Okay, 300. So what does 372% return? That means if you buy it at 10,000, now you are getting 37,000. And the dividend you collected is more than the amount you invested. So that is what is. And Mapletree Industrial Trust, 369%, very close to Mapletree Logistics Trust. That means that you also make more than 300% return. What about the Mapletree Pan Asia Commercial Trust? A merger between two REITs. It also not that bad. You give it 238%. So your money double. Compared with what? So there's always a relative index. Compared with what? Compared with STI. But of course, STI, the timeline is from 2008 until now. So it's in between Mapletree Industrial Trust. It's not really exactly the same timeline, but a few years don't make a big difference in their returns expect because the gap is too big. STI only give you 140% returns. And compared with the REITs index, of course, the REITs index even shorter, 10 years history, but the REITs index only give you about 64% returns. So this shows that these three REITs, over the long run since IPO, they have actually give very, very good return to a lot of investors. And pre-COVID, actually is a REIT that no-brainer. If you want to buy REITs, just buy Mapletree. So it become a no-brainer investment. But when COVID come, a lot of things have changed. A lot of things have changed. The market have changed. Everything has changed. And you look at the chart here. From here, you draw this line. You look at the performance of these three REITs. Compared to here, it is very clear cut all the way up. But you look at after COVID, it is, some of you look at it look like sideways or down. Okay. So that is what this street now is since COVID until today. This is they are doing this way. So is it worthwhile for us to continue to invest these three REITs, or is this just a correction or just a sideways up market? After that, they are there to go. Just like US market, we know that US market is on up, long term is up, but there's also a period of time they have been sideways for more than 10 years before finally they ready again. So it is streaming like that. So let's now look at, but we don't know the future, but let's just look at how are they now. Is it worthwhile to consider them to be part of your risk portfolio? So this is what we're going to talk about today. And in case you got any question, just post on that. But do take note, our focus is only on these three. Please don't ask me other risks. I can do other risks on other webinar next time. If not, will be a question for all risks. Okay, so now let's look at that. So to look at it on a near perspective, I use their latest financial result, which they just announced last month, July. Okay, July they have their earnings result, their first quarter earnings result. So we're going to look at it and look at the REITs, and from there we see how are they and how have they been performing after the COVID side. Just some context for those that don't know, Mapletree Logistics do what? It is a logistic REIT. What does logistic mean? Warehouse. Okay, warehouse. And that is what they are. And in terms of number of properties, when it comes to REITs, especially REITs comparison, there's always something I always say, that is size really matters. Okay, so that's one thing. Size matters. What happened? Okay. Size really matters. Okay. Another one is quantity really matters. Number of properties. So these are the two things that go hand in hand when you want to invest REITs on that. Size and quantity really matters. And let's look at number of properties. Mapletree Logistics have 178. It is, if I'm not wrong, latest record, they should be the number 2 in terms of number of property they have. Okay, they are number 2. So they really got quantities. And with the quantity, they are also indirectly have size. They are the top 4 biggest REITs in Singapore in terms of market cap. So this is what Mapletree Logistics Trust is. So they really have size and they have quantities. And next is that a lot of people talk about investment, you need to diversify. So this logistics trust is diverse over the Asia Pacific region. So over the Asia Pacific region is from Singapore, Hong Kong, China, Japan, South Korea, Australia, Malaysia, Vietnam. So this is the Asia Pacific region. Australia is under the Pacific Ocean side, but there's one part is India. It's not under Asia Pacific region. That's where they branch out of Asia Pacific. They got 3. So they are diversified over this region. So one thing you need to take note of this REIT is it do not have any exposure on Europe or US. It's only on this part of the world. So the time zone difference is not that big. Okay, the time zone difference from Singapore is not that big. So these are and it cover developing country and developed countries. So 2 parts. So it cover developing country and developed country. So it's a well spread between that. But mainly Singapore is still the biggest with 45 properties. But coming number 2, unfortunately or fortunately, it turned out to be China. 42 properties. So these 90 properties. So, and followed by Hong Kong, followed by, of course, Japan, Korea, double digit, Australia, Malaysia, and Vietnam, India, and Hong Kong, they got 9 property. So that is a key part, China. China, as we know, China is booming until COVID come. Then China no longer booming anymore. And China had pulled out a lot of things. And this REIT, because of their China exposure, got 42 properties. just slightly less than Singapore only. And we know China property market have slumped, and thus it actually impact this risk, in general. So let's look at where is their asset, and let's look at the revenues contribution. So Singapore 20%, China 17.9%, Hong Kong 22.5%. You'll be quite surprised at Hong Kong how many property they have only. They only have 9 properties. But the contribution of Hong Kong in terms of asset is more than Singapore. So that is one part of that, and China 17.5. So you put Hong Kong and China as one, they are contributing close to 40% to the portfolio on that. And let's look at the revenue generated. Singapore is the main contributor, 26%. And China and Hong Kong add together will be a bigger contributor, but individual they are lesser. They are the rank second. But from there, do you see a thing that's not so balanced? Singapore asset only contribute is only 20%, but the contribution is 28%. Where China and Hong Kong have 40% of their asset, contribute 40% to their asset. But in terms of monetary contribution, they are just 30%. So what does this indirectly tell you? That this indirectly tell you that means they are not able to generate the income as per the asset they are able to win, which means this is what indirectly what is the reason that pull down Mapletree Logistics Trust. They got the asset there, but the asset is not able to generate the revenue in that percentage to the investor, and that. So that is what Mapletree Logistics Trust now on the location aspect. So let's look at the dividend history. This is the one I plotted out. Manually, I key in all the data, as now I cannot find this chart anymore. So you just need to look at the dividend trend on that. So the IPO in 2025, of course, that is not even 1 quarter, so that's how it goes. But you can see that you have go up, then it dip during a COVID period, the global financial crisis. That one understandable. But after it recover, but do take note, this 8.24 is based on 5 quarter. Not so it is based on 15 months, not 12 months. And thus don't suddenly expect it suddenly shoot up. It go up by shoot up. You can see because they change their financial years. But after that, you can see that the dividend has steadily increased. Actually, it have steadily increased. It didn't increase a lot, but stay until financial 2022-2023, it hit 9 cents. So your dividend from 5 cents go to 9 cents actually is very, very good. But after that, you can see it start to taper off and it start to drop. So that is what we don't want to see for a risk. And this one is only 1 quarter, so we can't tell. But if you take 1 quarter, if times 4, let's assume steady state, it's actually down further. But hope that the next few quarter will be higher. But if it's just steady state, then it's actually dividend come down. I mean the dividend went up, and even during COVID period, it still continue to go up. As we know, logistics benefit from the COVID as e-commerce pick up. But after that, you can see it start to come down. So this is what is happening to Mapletree Logistics Trust at this juncture. And let's look at their key financial highlights. So their occupancy rate is very, very healthy. And this is just a sign for you to see. But you see what I look at it, I focus on this one. What you want to focus, what I focus is a year-on-year drop in dividend is 12.4%. And that is a lot. A double-digit drop in dividends. But let's look at what actually it means by that. So this is based on this quarter compared to last year 1 quarter. So 1 year ago, their dividend have dropped by 12%. Their dividend have dropped by 12% on that aspect. But you look at their borrowing cost only up 2.3. All this revenue, everything dropped by little bit only, but their dividend itself dropped by 12%. For those that are new to REITs, there's two ways a REITs can pay dividends. Actually, more than two ways. But the normal two way. One is their income. They have to pay up 90% of their income out from the renter as to unit holder like you and me as dividend. Plus, there's another one way is called investment gain, or we call it divestment gain. What do you mean by that? I mean they sell properties, and the profit they collect from the properties, the manager have the rights to take the money from the gain from the selling of the property to give it to investor as a form of dividends. So that is what they mean. And thus you can see they got two calculations. They say that it's dropped 12.4%, but you look at this, it's just based on purely on income. It is dropped by 7.3%. Okay, so you can see they call it as excluding diversity. That means it's just based on units only. Adjusted DPU, it only dropped by 7.3%. There's another 5% drop because there's no divestment gain. They didn't really sell as much property as compared to the previous financial year to give you that. But no matter how they put it there, the way they're putting it is just to tone down the drop. Okay, it's just to tone down, it's presentation. So it is presentation. So it's just to tone down the drop on that to make investor feel better. 12.4 actually is not really the income drop, is less of some selling of property. Selling property you see is only one time off. So but ultimately the income is still dropped by 7.3%. No, take note the revenue didn't drop so much, but the income dropped a lot. Okay, so that is one thing need to take note. The dividend have dropped for last year, but a lot of people say 1 year ago is too far away. Let's just don't look at 1 year. Let's look at compared to last quarter. Yes, last year December. How it may make you feel better? Actually, it's increased. Right, compared to last quarter, but as an investor, actually you get lesser lah. As they don't have divestment gain. They don't have divestment over the past few quarters. So ultimately you get lesser because the other one is because of divestment. But one thing, this is more of a consolation that means that their revenue didn't really drop from last quarter to this quarter, minus all the expenses, despite borrowing costs go up, despite revenue drop, despite property expenses. But property expenses also drop. So the cost come down, and thus you can say that it is flat, exclude diversion. So at least this something look better in the way, on the way expect. Okay, but ultimately it is still a negative things. It's still not so healthy at this juncture. But let's look at their financial side aspect. So this is their financial aspect, and now they are 41.2%. That's their gearing. 49.2 compared to 40.7. It is still very healthy. It is very sorry. It is still very, very healthy, and their interest cover ratio is 2.9, which is not that ideal. As a lot of you will be aware that I prefer interest cover ratio to be more than 3. For them, they have dropped to 2.9, which is not that ideal, but it's still very close to 3. Anytime can go back to 3. So that is what they are now. But next thing that's not so healthy is the NAV, net asset value, have dropped from 131 to 126. So their net asset value have actually dropped. So this is our financial statement now. So what does this tell us, or what does this tell me? My interpretation is that with this type of financial situation, if Mapletree Logistics Trust were to go and do a bulk purchase, and this is what you see they like to do last time, bulk purchase, because of their size, they one time can buy 10 properties, 12 property at one go. If they were to go and do this bulk purchase in going forward in the next few months or maybe in the next 12 months, they will need to do equity fundraising. They will need to do equity fundraising. And that is their star. Their star for Mapletree Logistics Trust, although now they changed the new CEO, but I think the tradition should continue is that what they do is they always like to do one time of equity fundraising, to do one bulk purchase, then from there, their gearing will come down. After that, they start to buy property, and the gearing come up. Then come on equity fundraising, then the gearing come down again. So that's what they do. So, and usually they do it after when it's about very close to 40%. Now it's 41.2%. I'm not the risk manager, this is what I guess only based on their tradition. So if they were to do bulk purchase, there is a potential of equity fundraising. But due to current market situation, they may not do that. So we may not able to expect any fund. I think they may not do any equity fundraising on that. One of the key reason is interest cover ratio is not high. And number two, their NAV is dropping. When you want to do equity fundraising, NAV rising, that's the best time to do. But when this one is dropping and this one is on the low side, equity fundraising may not be an ideal choice for them. Okay, so that is what my view on that. There's a question asked. Will MLT have right issue going forward? That's what I just mentioned. I don't know. Nobody knows. They will not have right issues unless they got bulk purchase. That's based on my understanding of them. Okay, but I may be wrong because it's a new CEO. The new CEO may have her own way of doing it, but the main boss is still the Mapletree, so maybe all are quite standardized. So I don't think they will have right issues, and I don't think they will have right issue going forward because they don't need the money. They are still very healthy. They are still very healthy unless they're going to do bulk purchase. If one property, two property, they no need to do that. They will not, no need to do any right issues at all. Okay, so that is my view on that. Okay, and next, and let's look at their debt. And we know that interest rates have been coming down, but do take note for Mapletree Logistics Trust is across the Asia Pacific region. So we cannot use Singapore interest rate as a benchmark. And we also cannot use US interest rate as a benchmark. First thing, they don't have USD. They don't have USD loan. And Singapore only contribute 20% of their asset. The rest are all in part. So the interest rate of individual country movement will affect the borrowing as they will borrow in that local currency. Okay, so what is coming due is this is the debt that's coming over, but one thing good is that it is on a low percentage chart. It is on a low percentage. You see, I don't like anything that's more than 20%. But at least for the next few years, anyway, this 21% will change over time as the thing will change along the way. So this is too far to be any concern. To me, it's too far to be any concern because when in time they pay any properties along the way, they can pay down debt or they can sell off property along the way. So too far away, not a concern. But look at the next few years, it's actually still reasonable, still quite okay. And the main bulk on them, you look at the color code. I don't know what gray color is what. Okay, but technically they are quite well spread on the debt refinancing part. I don't think there is an issue on that. But they got a challenge because they are over too many countries, and thus there is all this thing called forex risk. And one part they will affect them is because we are in Singapore, we get the dividend in Singapore, and the dividend contributed by the REITs is more than 70% of the income is come from non-SGD currency. And we are lucky to have a strong Sing dollar, but it's also unfortunate because we have a strong Sing dollar. For example, China, they collect the dividend in renminbi. but they need to convert to Sing dollar to pay to us in Sing dollar dividend. They collect the dividend in Malaysia in ringgit, and they need to convert to Sing dollar to pay to us. And this will direct what if Singapore dollar continue to remain strong and become stronger against the currency. If all things stay the same, our dividend will drop because of forex exchange. Although they hedge, but they cannot hedge 100%. So there is still some unhedged risk there on that. So this is why indirectly become more challenging to you can look at practically all the currency against Sing dollar all have weakened, even US dollar. So all the property in overseas come back to Singapore, all will face challenge on that. So that one can't be helped. But you also can consider good that we have a very strong Sing dollar on that. It's just our investment all overseas then come back. So that is another challenge they are facing on the side because we are collecting Sing dollar and they cannot hedge 100%. And hedging costs money some more. So that is coming help, but they are managing quite well in a way a high percentage is hedged. So at least it maintain a good base for us. Another one we want to look at is called the occupancy risk. And it's very good, 90%. Actually, more than 90% is considered very good. And more than 95%, I'll say I'll give that A star. A star on that. But there's one part that is not don't have an A star performance is China. And to take note, China, the asset is quite a significant portion to them. And this actually indirectly, China have pulled them down on the occupancy rate. It have come down quite a fair bit on this. And actually, Singapore actually also come down. You look at the June side. From 95% drop to 93. So Singapore, which is, you depend a lot on Singapore, but you also have come down quite. So Singapore also suffer in a way. This may indirectly explain why the dividend also drop. Okay. And another one we want to look at the healthy side or not is the rental reversion. And this is something to me, it is quite, you can say it's alarming or not healthy. 2 consecutive quarter actually in fact more than that of negative rental reversion, and the negative rental reversion increase. First thing, the property occupancy have been dropping, although it's still above 90% is way above the norm, but they able to retain the existing client, okay, with a discount to renter. In Singapore, I think rental keep on go up, non-stop one. That's a previously my team operate the investor center at Westgate at Jurong East. The only thing we face is every year the rental just go up. Even COVID, the landlord just don't care, increase rental and increase until unreasonable level. So we found that it don't make sense for us to sometimes to continue with the investor center, especially after COVID, people don't come to investor center. So in Singapore context, it's a landlord market. But when it comes to China, it's a bit a different story. It's the tenant market already. The landlord got no power. And thus, this is what they have been. Over the portfolio, able to generate a 5.1%, exclude China, they generate 6.9. But because of this, so investor is this way. They don't care how the overall portfolio look at. They say, hey, you got China exposure and got China property exposure, and China property market is weak. What they do, dump the shares, dump the price. And this will create price weakness on the share. They don't look at everything as a whole. They look at, hey, got China some 20% exposure. Then they'll just wait. So that is what is affecting Mapletree Holistic Trust. So in general, this is what the manager say. And they have been saying that there's a rising borrowing cost. As I mentioned, the borrowing cost, you have to look at the region they are looking at, not looking at Singapore context and not looking at US context. They look at that. And actually to me, the key part is the currency depreciation and the Sing dollars. So this is another part on that, and another part is the occupancy of China and negative rental reversion, which actually it affect the thing. So in conclusion, in conclusion of this REIT is e-commerce will definitely be there to go unless you don't believe in e-commerce. But their China exposure will always be there. And the China exposure in terms of weightage, I don't think will drop in that if they are doing for the long haul. I don't think China exposure will drop to 10%. I don't think they will do that because China is a market that cannot ignore. But at current market juncture, it's really challenging for China side. So if you look at Mapletree Logistics Trust, I myself also hold Mapletree Logistics Trust. Okay, so and I do not for myself, I do not intend to sell it any of my Mapletree Logistics Trust. But I also do not have any plan to add Mapletree Logistics Trust at this juncture, even for my client, expect as I manage portfolio for my client also. All because they will buy what I buy. This is how I manage my client portfolio. I only buy what I buy. If I don't buy, I don't buy for client. Okay, it's always online. So and it's also easy for me to manage. I buy what my client what I buy what, then my client buy what. So that means we are all on the same boat on that. So at this market juncture, that is what Mapletree Logistics Trust is. To me, it is still a good REITs. It's still a good REITs. They still got very good sponsor and they still got very good manager. One thing I like about Mapletree REITs in general is that they always have the investor in mind is that if they were to buy any properties, they'll make sure that the property were able to increase dividends to the investor. If not, they will not buy. Not many REITs do that. Not many risk managers do that. The first criteria is dividend must be accretive, NAV must be accretive. So that is what I think the three Mapletree manager all have the same wavelength because maybe that's driven up by the sponsor. Every year they are doing and that. So you go and look at all the Mapletree purchase in the past, you will see that when they buy any properties, their DPU will go up one. And in general, NAV will go up one. They always want to benefit investor. And if when they do a right issues, okay, when they do an equity fundraising, right? If you don't subscribe for the equity fundraising, you will not be worse off because your dividend will still increase. That is based on their past track record. You don't believe me, you go and track back all their equity fundraising on that. They will always be there. So this is one thing good about them. But unfortunately, Mapletree Logistics Trust is really pulled down by the China exposure in general, and also pulled down by our strong Sing dollar, as more than 70% of their currency are overseas. So that is what Mapletree Logistics Trust is. Okay. So now let's move on to the second Mapletree REIT, which is the Mapletree Industrial Trust. Mapletree Industrial Trust. As Mapletree Industrial Trust have went through a transformation over the years. He IPO at 2011 with a focus on Singapore industrial. So it's a pure Singapore play industrial REITs. That means they have all segment of Singapore industrial on that. So they are just the pulse of Singapore economy because it's industrial. So Singapore economy go up, go for this REIT, and Singapore economy have been growing, and thus this REIT have been performed very well. But before COVID, few years before COVID, they have decided to make a change to their mandate. I think there's no choice. They need to make the change in order to survive and grow. That's all REITs need to survive and grow. They change their mandate. There's some background on that for those that are new to this REIT. They have decided to make a change that they need to go overseas. They have to go overseas in order for them to continue to prosper and grow. But they change their mandate that when they go overseas, they are very selective in going overseas. What do you mean by that? They are industrial REITs, but the property they are allowed to buy in overseas, okay, they restrict the property they're going to buy. And you know what their mandate say that they will buy any Singapore industrial building that's Singapore, but if the property is overseas, they can only buy one property called data center. they can only buy data center in overseas. They cannot buy business park. They cannot buy warehouse logistics in overseas. That's their mandate. So for those not aware, all risk manager have a mandate tell you that what they will buy, what they can buy, and what they will not buy is all specified in black and white. And if they want to buy anything out of that, they need to change the mandate. So, and of course, no risk manager will just constantly change the mandate lah. And then people don't even buy that risk because it becomes fickle-minded. So they change it. So they'll buy data center. And after that, they make a very big move. They go into US to buy data centers. And this is what Mapletree Industrial Trust now. It is had 140 properties. It had 100 properties. And it data center, you look at how much it contribute to the portfolio now, 54%. Okay, so the Mapletree Logistics Trust had contribute more than 50% of the risk now compared to that. So that's the transformation they have done over the past on that. And this is where they are. And you can see Singapore data center is only 3.3. And initially they are on North America. And for those that are aware, they have started to go into Japan as a form of diversification. In that don't focus on country risk, US only. So they have go into Osaka and they buy data center. And this is where their contribution. And Singapore contribute only not more than 50%. So they are, and US is about half, and Japan is 7.3. And it's a 9 billion AUM asset. And we know of data center, we know of Capital DC, we know of the digital core, then we know later NTT. Okay, but if these three REITs were to add together on the data center aspect, they are still smaller than Mapletree Industrial Trust on the data center side only. Okay, not at the REIT side, they are still smaller on this. So some people even take that Mapletree Industrial Trust as a proxy to data center REITs in the Asia Pacific region, not Capital DC, not Digital Core, or not NTT, because they are too big to be ignored. So that is what data. So you are investing in data center. Don't just look at these three. You should also look at Mapletree Industrial Trust as the data center is their key force now, where contribute more than 50% of their revenue, and they are so big. So that is what they have. Okay, now let's look at their DPU. This is the DPU they are growing. There's IPO in 1011, so that is their DPU. But after that, you can see their DPU have been steadily increased over time. And do take note they are post-COVID, post-global financial crisis. So they have been growing until here, 13.8, which is post-COVID already. But you can see then it start to slowly dip. Some people say it's stable. Okay, it's stable. But compared to their peak, it's lower, but it's still higher than this one. So practically, you can say that their DPU have become flat. No growth over the past few years. And this will indirectly transfer to the share price is also flat. Okay. So this is what Mapletree, but it looked better than Mapletree or Six Trust in terms of DPU side. At least they are flat on that. And of course, this is 1 quarter, so we don't know what's the next 4 quarter. We hope that it will be better, or maybe it will flat, because now it's 3.27. It times 4 is still around 13 plus. Okay, hope that on that. And this is our result. So one thing about the result is that this is something that is no good also. DPU, the distribution drop, DPU drop, DPU exclude divestment or one-off compensation also drop. So that is what investors don't like to see. They are also drop in their DPU. And let's just go into the financial data on that. Okay, so their DPU compared to last year, 1 year ago, it dropped by 4.7%. And they will need to split off from divestment gain, right? It still dropped 1.5%. Ultimately, no matter how you look at from left from right, it still dropped. Okay, it's still on a drop trend for 1 quarter side. But that's 1 year ago. So let's look at compared to last quarter. Overall DPU have dropped, but if do not exclude divestment, actually their DPU have increased. Okay, actually there's a consolation part. Their DPU have increased by 2.6%. But you don't have every time got divestment gain one. You don't sell property every quarter. Okay, you don't expect rich manager to keep on sell property every quarter. So at least they still got it's still on a slightly positive note, 2.8%. And let's hope that next quarter will be better on that. But let's look at the financials data. They have a similar fate with Mapletree Logistics Trust, NAB drop. Okay, NAB drop, that is what they are having now. And next, let's look at their balance sheet. 40%. 40%. And their ICR, this one thing I will need to say that it is very, very healthy. So you can see 2.9 times for Mapletree Logistics Trust, but it's 3.9 times for Mapletree Industrial Trust. So to me, it is very, very healthy. It is one of the most healthier REITs in terms of interest cover ratio in all the 30 over REITs. At this current market junction, they can get 3.9%. It is very good. To me, it's very, very good management on that. And the aggregate gearing ratio is 40.1. So this is something you need to take note. So whenever the thing cross 40, you see there is a ceiling. There is an invisible ceiling, they will go. Okay, that they will go. The invisible ceiling is around 42 to 43%. That's what you see a good risk will do. They will not go to 45, 46. That's too risky a risk will go. So the invisible ceiling is around 42, 43, and sometimes even 41 on that. So with a 40.1% leverage ratio, they will buy property, yes, one at a time can, but if they were to do bulk purchase, then same thing, equity fundraising is expected. So that's, I mean, if they are 35%, I think no worries, they can do bulk purchase. But they are at 40% reach, so equity fundraising. So one thing, when you buy REITs, you must be able to accept equity fundraising. It cannot escape one. But it's just a good or bad equity fundraising. But for them, I actually have faith in Mapletree REITs when they do equity fundraising. They all put their investor at heart one. So when you do equity fundraising, even if you don't subscribe, I think you are still better off on that. So that's something that's to take note on that. But if they just buy one data center at one go, I think not a big issue, because although data center is much more expensive, cost more money compared to logistics or buy warehouses. But because of their size, they are able to do it. Just at the Osaka data center they buy without asking retail investor for money. Okay. And next, look at the debt distribution profile. 17%, but anyway, this is being taken care of. 17%, yes, but this part, 24% is slightly on the higher side. Slightly on the higher side, and do think that are all bank loans. So the member of this are all bank loans. They need to refinance with the banks. So it's above 20%. It will be a blessing if the interest rate at this point of time is lower than now. Then 20% will not be that much. But if this interest rate at this 2.2728 is higher, then will really add stress to these streets. Okay, so this is why I don't like 20%, more than 20% is because of the interest rate risk we don't know at the point of time. Of course, it's lower than higher, no issue. Wow, they got even lower financial costs. That one is not a big issue at all. But what happens if it's higher? Then that will be a challenge. So that is something to think of. But the manager always plan ahead. You can see that this 47.9 million already being taken care of already. Okay, no, sorry, this is a joint venture loan. This is a joint venture loan on that. So this is something you need to take note on that. And the currency profile, that's another part, is that main bulk is in USD. SGD is only contribute about 18.5%. So that is another challenge they will face, is the forex risk. And we know that Jap, okay, Canadian dollar or USD all depreciate against Sing dollar. So that is the bad part of it is the three major currency, especially US dollar, depreciate against Sing dollar for this year haven't crossed 10% yet, but we crossed 10%. We don't know. US dollar is weakening. So that's a currency risk that are exposing. Only 18.5% is Sing dollars. Okay. And of course they will hedge. One thing their hedge is close to 90%. Total or derived from Singapore is close to 90%. It's better than Mapletree Logistics Trust, but the currency risk is still there. A lot of people say 10%, 10% not a lot. 10% is actually quite a lot. Do remember the size. There are 9 billion AUM. So the impact is still there on that. And occupancy ratios is not very ideal. I personally feel that it's not very ideal. As a portfolio, it's only 91.4%. To me, that is considered low. Okay. And a lot of people say data center is good, but I look at that data center occupancy, 88%, which is quite bad. It's quite below 90% to me is not that good. So the occupancy from US data center which is not that good. So this is why I think they have foresight on that they start to divest into Japan, other countries. So you see Japan's already 100%. But because it's a new property 100%, but we don't know going forward how is it. So that is something on that. And you look at Singapore side, 92.6, but you look at the breakdown, similarly, this is the weak part, high tech and business park. And this is not only they are facing this challenge, all the while business park have been very weak for them. And not only them, Ascenders also same. You look at Ascenders business park occupancy in Singapore also the same. So you go and look at Changi Business Park, you go and look at Jurong International Business Park. I think you can see relatively empty in that aspect. So you can really have a feel of how is it. So it is really, I think business park have been challenging for quite a while already on that. And the data center is 80, also in Singapore context also less than 90%. So it is not only US side, Singapore also the same. So it's more of a phenomenon. They can only hide away. And this is, and of course they got over sector, but that is just to diversify. But usually you focus on the big one, 6.1%, that is a part. Current HP, I think no issue, but we don't know going forward. Okay, and this is their mix of data center. You need to zoom in. For those that are new to data center usually got three types. Actually mainly two types. One is called the superscaler and one is called the co-location side on that. And for them, their data center are using more on a triple net lease. It's a bit different from the data center Keppel DC have or even the data center Ascenders have. For those not aware, Ascenders also got data center. And as the Ascender data center is bigger than digital core. Okay, and bigger than digital core for those not aware. So it's I think comparable, smaller than Keppel DC, but they can always beat Keppel DC anytime because of their size. So one thing about them, their data center is mainly on triple net lease or double net lease. So because of them, and they are hyperscale, but there's another thing is called co-location site. So data center a bit complex in a way that they hyperscaler, PowerShell, fitted data center, triple net lease, and co-location. So, but they are practically quite diversified, and I prefer them to be mainly on triple net lease. Expect, if you are confused about data center, maybe next week going forward, I may do a webinar just talk about data center risk. Okay, so that I can explain more on that. So, but usually I prefer a triple net lease REITs on that, so that it's just collect rental only. That's like healthcare REITs is triple net lease. So data center is also triple net, can be triple net lease on that. Okay, so this is but let's look at rental reversion. Singapore expect is still very strong, 11.2%. 10.5%, that's last quarter. This latest is still very, very strong on Singapore side. So that's on the rental reversion side. So this is what they are doing. And of course, this is a standard cost. They always tell you what they do. And this is what all REITs will do. They'll rebalance their portfolio. They'll reposition. And in fact, they are repositioning themselves or the property where they start to go into Japan to buy data center. They're supposed to have a data center to buy in Hong Kong, but I think never materialized as of now, because I think maybe that of the market is there on that. So this is what they are going to do. And to me, is my personal take is that if you ask me to choose two REITs between Mapletree Logistics Trust and Mapletree Industrial Trust, you say that you can only buy one, and then I'll say that Mapletree Industrial Trust will be a better bet compared to Mapletree Logistics Trust. Okay. One of the key reason is they do not have China exposure. China may be turn around, may be very fast, and Mapletree Logistics may just boom. But you ask me to talk about logistics and data center, I still think that data center will be a better bet compared to warehouse in the growth aspect. And also they got 40% contribution in Singapore. When it comes to REITs investment, we are collecting dividend in Sing dollars. So property in Singapore actually is very crucial for us when it comes to REITs investment. On that, as Sing dollar remains strong. If Sing dollar is weak, then of course a property investment with Singapore may not be better. Invest in overseas property may be better because convert back you get more dollars. But we have a very strong Sing dollar, and IMF's policy always remains strong for Sing dollars. So thus, when it comes to REITs investment, you will want to look at whether the risk of property in Singapore or not. And whether would they have a significant property in Singapore. That is another part of consideration for REITs investment, especially at this juncture. Okay. So now let's look at the third REITs, which is called Mapletree Pan Asia Commercial Trust. This is a REIT, I think some background for those that new to this, is a merger between two REITs. One is called Mapletree Commercial Trust, which is one of the best performing REITs in Singapore. Merged with another REIT called Mapletree North Asia Commercial Trust, which was being hit very badly before COVID. Before COVID was being hit very badly. First thing is there is a social incident happened in Hong Kong, and this REIT have a concentration risk in Hong Kong, when more than 50% of their income is from Hong Kong and from one properties. And that is a risk of risk investment is concentration risk, single country, single properties. There's a very, very high risk exposure on that. But before that, nobody will mention that, oh, there's a very high risk there on the high side. Everything will happen, and then they say that. Before that, everything, wow, this is very good because they got a very concentrated return from Hong Kong, and Hong Kong is booming. But until the social incident come, people then tell, hey, you should not have this, should not do that. Okay. So a lot of people become very good after thing happen. Then say should not do that. But before that, everyone say, oh, it's very good exposure, it's very good thing. Okay. On that. So after that, COVID come, China get hit. Because this week not only have Hong Kong, you also have China. And thus, then they will start to diversify, try to mitigate the risk of that. Then they start to buy Japan property. One go buys about 6 Japan property from their sponsor. So I think that one is a desperate attempt. During that point of time, they just want to mitigate the risk of China and Hong Kong. And the property in Japan is not tip-top property. It's okay property. So they just buy it in. But I think still cannot solve the problem. And finally, they decided to merge together with Mapletree Commercial Trust. Mapletree Commercial Trust. And the sponsor have done a very good job to me in that aspect is that they know that investors don't want to buy. So practically, they buy everything in. I think no investor opt to get it to them because they sell they offer at a premium price on that, and this is why now the sponsor got very high stake on these REITs, where they got more than 50% stake on these REITs. Okay, one of the highest among of the 30 over REITs. He got very high stake, which when talk about sponsorship, sponsor need to have a stake in the REITs, but if you don't want a sponsor to have low stake in the REIT, means that the sponsor is not interested. They take these REITs as a dumping ground for them to dump property to make cash out their money. Okay, but if the sponsor have very high stake on the REITs, it also means that there is no efficiency to the REITs. No efficiency to the REITs. So it is not on the optimal range. And not on the optimal range, the sponsor will need to reduce their holdings on the REITs. The issue of Mapletree is that they are not able to reduce. They are not able to reduce compared to Capital Land. Okay, compared to Capital Land, compared to Keppel Group. Why is that so? Because Capital and Keppel are listed. So for those that hold Keppel share and Capital Land Invest share, you'll notice that certain time suddenly Capital Land Invest give you what? CICT shares, give you what? Capital Land Escort Trust shares as dividend in specie. Keppel Group, what? Give you Keppel REIT share, Keppel Infrastructure shares. Correct? This is how they par out their weightage on the REITs by giving out to as a dividend in species. But Mapletree is not listed. They cannot give out. So they can't bring down their holding on that. The only way they can bring down is to dump the shares. But they will not do that. I will say that they will not do. I think they never say never, but I think they will never do that. Because if they dump the share price will crash. So being Temasek, I don't think they will dare to do that also. Okay, so that is the challenge. I don't know what they're going to do with the reduced holding side on that. So that is something for us to see. Maybe they'll find an innovative way in future. I don't know how they're going to do it. They cannot say that they give you Mapletree or say trust dividend plus Mapletree North Asia dividend. I don't think that is possible because it's not a company. So that is something for us to see. So there is some background on this for those that are new to this REITs. This is what that is. Okay, so now look at the current Mapletree Pan Asia Commercial Trust. They are still they have 15 property, which is considered quite a lot, given the market cap 6.6 billion, which is very big on that. And you look at the contribution of the AUM. Singapore is 57%. So they are still Singapore concentrated on that. Okay, and this is a post-divestment of Singapore asset. Okay, they still contribute. Ultimately, they still maintain Singapore as more than 50%. If they don't have Singapore more than 50%, I think the share price will crash. The share price will crash. They already crashed, but will crash even worse. Okay, but lately this share price has went up for the being aware of that. Okay, so they got Hong Kong 26%, China 9%, Japan 7%, and Korea very low 2%. So that is what they do. And they tell you they are what? Mapletree Pan Asia. So what does Pan Asia mean? Pan Asia means they will buy property in Hong Kong, Japan, China, and Korea. That's called Pan Asia. You will not expect them to go India to buy property. You will not expect them to go down to Australia to buy property because they predefine they are where they are Pan Asia. Pan Asia is the Northeast Asia. Okay, Pan Pacific Asia. So they are on the Northeast Asia side. So roughly you can know where their property will be buying. On that, if they want to buy Australia property, all this, they need to change their mandate, which I don't think they will do it. So that is what they are doing on that. So this is what they have. And they are called commercial REITs. So what does mean? They'll buy shopping mall and they'll buy office building. So one thing for sure, they will not buy any industrial building. They will not buy any data centers. They will not buy any warehouse. So they are focused on office and shopping malls. So that is what the REITs mandate is on that. And this is their DPU on that. Let's just look at their DPU trend. Okay, so this is take from their website. So I don't know, did they adjust their DPU for merger a bit before merger? I presume they will they have to adjust. So you can see that their dividend actually is on an uptrend. Okay, on an uptrend until here. Until here. Okay. Now after that, it dropped. And it not dropped slowly, it dropped pretty fast from 9.6 to 8. That is a lot of drop. There's a lot of drop on that. That's more than 10% drop in dividends over the past 2 years. And of course, the first quarter is 2 is times 4 is only 8. So it never come back to 9. Okay, so that is what their trend is. They have cut to come down on that. So it's similar to Mapletree Logistics Trust on their dividend trend, I expect. And for the information of everyone, when they want to buy REITs, unfortunately, we don't really have REITs that their dividend grow up yearly basis, but except Parkway Life, you can see that they are going yearly basis, but of course they put in divestment gain inside to adjust the DPU to be on the uptrend. But in terms of purely rental income, I don't think we have REITs that their dividend grow up every year. I mean, just purely based on renting, because the REITs can massage their dividend in a way that they tell my dividend grow up every year. It's just that I use other way to top up the dividend for you. It's something like divestment. I sell a property, make the capital gain top up. They tell, hey, your dividend increased from last year. But just purely based on rental income alone, I think we don't have the REITs that are able to increase dividend every year. We don't have it in Singapore context. Okay. But on the uptrend, yes. Like Parkway Life REIT is the uptrend. Their dividend is on the uptrend. But I think it's the only REIT that is on the uptrend. Don't really have a dip. Other REITs have a dip. Okay. So that's something when it comes to REITs investment, do take note. Dividend in Singapore context, we don't really have a track record of REITs that really uptrend all the way on. Compared to US, a bit different. US have REITs that uptrend all the way on. Okay. And this is the quarterly performance. The dividend is up 3.8%. Okay. 3.8%, but this time now they didn't put any those so-called divestment gain or what. Okay. So, but actually they have but the financial expenses, one thing you see it dropped a lot. Okay, it dropped a lot of 16.4%. But do take note, then you think, is it because of the renter have interest rate drop? Because they have sold off this Anson. Okay. Okay, they sold off Anson. So off Anson means that come down. So this is why there's a drastic 16.4% drop. And this is why there's operating expenses of the because of they sold off the Anson aspect. Okay. On this aspect. So their dividend actually also dropped by 3.8% year on year. Okay. That is something to need to take note. And they didn't use the divestment of Amson, okay, to top up dividends. So that's one thing for them is they didn't sell the Amson just like Mapletree Logistics Trust or Mapletree Industrial Trust. They sell property, then got some proceed they pay as well. But for Mapletree Innovation, no, they didn't take the divestment gain and pay as dividend. So this is just pure rental. So pure rental have dropped. And this is the contribution on that. And core asset. So for those that don't know what is core asset, for Mapletree North Asia Commercial Trust, they got two core asset, which is not for sale. That means that no matter what, they will not sell it, at least in the foreseeable future. Yeah, I mean, and no, but any buyer tell them they want to buy, they will tell them it's not for sale. These are the two core assets is Vivo City and Mapletree Business City. So these are the two property they will not sell. They cannot sell. Actually, if they were to sell, the share price will crash. These are the two property that support these REITs. Other property they can sell. The rest of the property they can sell. In fact, I think they may want to sell festival, what they may want to sell the China property, but cannot sell. Okay, cannot sell a good price. Not say cannot sell a good price. But for Vivo City and Mapletree Business Park City, they will never sell. So that's what they call core asset. Okay, so this is the core asset. These two is not for sale. Okay, if they were to sell, I would say they better dump the share and run. Okay, so that is what they are happening, and also similarly, the NAV also have dropped. The NAV also have dropped for them. And let's look at their financial management. They have dropped. Okay, it's on a very healthy level, 37.9%. But the ICR is 2.9 times. It have improved. But it's still not that good. Yeah, improved because they sell Anson. Okay, yeah, improved, but it's still not the ideal. It's not an idea. And also another thing about them, you see this Moody rating, BBA1, BBA2. So what does it mean? They have been downgraded by Moody. Okay, Moody found that their financial is not that good compared to the past. It's still very good. BBA2 is still investment grade. Because there's some REITs is uninvestable, non-investment grade REITs. I don't want to mention the name. They are being downgraded to be non-investable. Not say non-investable to become non-investment grade, but it is still an investment grade on that. Okay. Is this important? Yes, this is very important for a REIT because a REIT need to borrow money. The lower the credit rating is, the bank have to charge them a higher interest rate when they borrow money. And if the bank charge them a higher interest rate, they will have lesser dividend to pay to investor. So credit rating is very important for REITs because that will affect how much the bank will willing to borrow to them. So they are being suffered a downgrade by Moody. So a catalyst is this one will always change one. So one day if Moody were to upgrade them, that means their share price will also have a surge. The share price will also have a surge. So that's another thing you look at on the positive side is I think they will soon be able to upgrade back and then they will have a positive surge on that. And so this is that maturity table. And they got this one, same thing, 2728 is 22%. Okay, so that is one thing that, and it's still also same thing on the bank debt itself. So that's something we need to monitor on that. And in fact, that all above 20% for 3 consecutive years. So this is something we need to monitor for this aspect. And similarly, they got property overseas, they also need to hedge. So there's still 12% left unhedged. And with the weakening of renminbi, Hong Kong dollars, and yen against Sing dollar, it is not a good thing for them. Okay. And let's look at their portfolio aspect. So for them, they give very detailed portfolio occupancy. So they got only 2 shopping mall. One is called the Vivo City and one is called Festival Walk. Okay. So how I look at this data? First, I look at this thing called tenant sales. Tenant sales up or not? Yes, up 2.1%. Okay. But you also another thing, look at shopper traffic. Shopper traffic down 1.3%. So what does this tell you? Lesser people go to Vivo City, but they're able to sell more. So that has something good. Lesser people go to Vivo City and yet they're able to sell more. So this is a plus point. Okay, it's a start. Let's look at Festival Walk. Shopper traffic go up by 7.8%, almost double digit. But look at the sales. It dropped. So that is something that is a bad thing. More people go to Festival Walk, but people buying less. You can see it's packed with people, but the tenant tell you, hey, my sales drop. So that's what we mean by that. And one of the key reasons may be because due to a lot of people go Shenzhen. Do you think Festival Walk is not a downtown shopping mall? It's more of a suburban shopping mall in that aspect. Okay, a lot of Hong Kong go to Shenzhen, I said. So this may let you think of RTS or to open. What will be the impact to Causeway Point? Fraser Center Point, one of their key REITs, Causeway Point. Would they have an increase in shopper traffic? Definitely yes. They'll have a lot of shopper traffic increase. But would their sales go up or go down? This is something we need to monitor. You're looking at Fraser Center Point, sidetrack a bit. This is something, but that will be a few years later. Okay. And this is what happened. But it may can use festival as a reference to that. On that aspect. So this is what is negative on that. So this is something that is no good for them. And festival want to take note, it contribute a big percentage to the rich, 20%. Okay, and they are having a drop in tenant sales. And let's look at occupancy side. For China property, it is very, very weak. Less than 90%. Japan property even worse. 76%. Okay, 76%. So that is something that's pulling. And but China even 85, they are above average. So this is what they are happening now. Overall, the occupancy is not that fantastic, below 90. Pulled out by these two. Okay, pulled out by these two on that. And another thing is that one thing that's not the idea is this one. It was having a very good occupancy rate in the past, but over the past 1 year or few years, you can see some of the company downside. I think Google even reduced space there. Okay, if I'm not wrong. So this is why this is a challenge. Is their key asset, but it also face challenge because it's a business park. As I mentioned, business park in general all face trouble in a way, but they also face challenges on that. So that is why you also indirect effect because it's a Singapore property and their core asset and the occupancy rate have been dropping. So that's something you need to take note. And then let's look at rental reversion. Negative. So this will tell you challenge. They need to get the tenant to renew but at the lower rates or new tenant coming at the lower rates. The thing is the Singapore properties and facing negative rental reversion. So that's something. And this one is very, very bad. Minus 20%, close to 20%. It's really a tenant market. Festival Walk also very bad. After a while, still very bad. Negative rental reversion, 7.9%. So this is something that is pulling and they are more worse than Mapletree or Six Choice because of this. And of course, their Japan property is not the idea. And thus, you can see their rental reversion is only 1.4. It is very, very low. And this is the office and business side. So you can just look at this is a summary. You can see minus 19, Singapore minus 2.7. So it is, and even Japan is flat, but with a dropping occupancy rate on that. So this is, and you see the tenant retention rate is only 32.6%. Can't even retain the tenant. Okay, because there is a big tenant non-renewal on that. They don't want to renew already. So the retention rate is very, very low. On that, Korea, no need to say 100% Korea, but Korea is too small for the REITs itself, unless they got more Korea weightage. And this is the Vivo City. Vivo City tenant retention rate is very low, but rental reversion is very high. So Vivo City is a buyer, is a landlord market. The landlord just keep on increase rent until it cannot, it just go off. No need to worry. Another person will come over to take over. So Singapore retail side is a lot of people will see that, how come you always see the retail shop come and go, come and go, come and go? But the shopping mall still doing very strong. And that's a Singapore phenomenon aspect. Okay. You no need to worry about we don't short of entrepreneur that want to go into the retail market, especially F&B. We are not short of them. So they come in, cannot make it, close down, another person will come in and take over and continue run. And this is why they can charge increase rental with a low rental reversion rate, and they're still very strong. Okay, still very strong compared to Festival Walk. They are just begging the tenant to stay back by bringing down their rents. So it is a very different scenario being on that. But this will be bad for us. If they can maintain this one and this is positive, the share price will go up. So that's two parameters you need to look at. And thus, this is a summary on that. So this is what they are looking at. So they, of course, Singapore have to remain their core. No choice. No choice on that. And thus, now they really can't do much. To me, I say that first thing, they can't sell off the China properties. They can't sell off Festival Walk. The only thing they can do is looking at how to sell the Japan property, how to massage the Japan side on that, and maybe got chance to buy some Korean properties. This is what they can do. Although their gearing is 37% over, less than 38%, they can buy property, but first thing, buy what? They got no property to buy in Singapore. Put it very bluntly, they got no, I cannot say they got no property. They don't have ideal property to buy in Singapore. In fact, they sell off and sell. Okay, don't have idea. You look at the whole Pasir Panjang stretch. Can you name of a property that they can buy? Harbourfront cannot buy. Harbourfront, I think it's really not really that good. Does Harbourfront have crowd there? If you go to Vivo City and happen to go to Harbourfront, you see there's a heaven and earth different. Although Harbourfront belong to Mapletree, but I don't think they'll buy Harbourfront. Okay, so you look at the whole they don't have property to buy, and the property they'll buy is on a Pasir Panjang, the stretch of road only. There's no other property they'll look into it. They will not go to downtown Orchard area or CBD area to buy any property there, because that is not their mandate. They will not go there to buy. They will not go to any suburban side to buy any shopping mall there, and that's not their mandate to buy. That one is CICT mandate. Do think that CICT and Mapletree are same akong, so they don't clash one. They don't clash one. They will not go to downtown to go and snatch a shopping mall buy with CICT, because they are under the same boss. So in a way that you can see that they don't have a crisscross for Mapletree and CapitaLand shopping REITs itself. They don't really crisscross with one another. Okay, and this is what Temasek is smart, got different REITs on that. So they don't have. And what other property they can buy? It don't make sense for them to sink further into China. It don't make sense for them to sink further into Hong Kong. In fact, they need to reduce. And thus, the REITs will just need to stay put at this juncture and hope for China recovery. So that's my take on them at this juncture. They can't do much. Their hands are tied. So this is what Mapletree Pan Asia, North Asia Commercial Trust. Let me just ask. Can they go to Taiwan? I think it's this is a public webinar, but I think it's very sensitive politically. REITs have property in China, and same REITs have property in Taiwan. I think they will not want to step on this type of things. Okay, especially Temasek. It can be quite sensitive in this aspect on that. Okay, so I don't think they'll go Taiwan to buy. So that is another. So this is what the risk current structure is there. Okay, anyway, this is not the risk manager view. This is my view. This is how I view this risk is based on my understanding of them over the years and how they do things. Okay, on that. So this is something you need to take note. And so that's what Mapletree North Asia Commercial, Pan Asia Commercial Trust is now. So depend on your view on China and depend on your view on China properties. If you are very bullish on China over long term and you think that China property will have hit bottom and will turn around already, then this may be a good risk for you to position yourself. And another is Mapletree Holistic Trust. This will be the risk that you're able to position yourself to ride the next China wave. But if China, the slump continue, then these two risks will continue to slump. Okay, so that is something to think note on that. Okay, so this is the returns. Just like I show you, beginning of slide, I show you the returns of the REITs. They are very good REITs pre-COVID. After pre-COVID, you look at the graph. And after you can look at our STI is going up. Okay, the risk index is sideways. Why? Because these two REITs are heavy weights on the risk index. Of course, they will have a contribution to the risk index movement. And let's look nearer. 10 years. How does this REITs perform over the past 10 years? So this is the risk index. They are still better than the risk index. Okay, except who? Okay, I got this is the STI. They are, of course, they underperform the STI. STI is crazy during the past recent run because of the bank's run. Our bank run fast, very fast, so STI will go crazy. Risk is practically flat. Only Mapletree North Pan Asia is aligned with the REITs index. The other two still outperform over the past 10 years since 2016. But let's zoom in nearer 5 years. How have the REITs performed? Actually, it's quite shocking to see that the three Mapletree REITs, okay, the three Mapletree REITs, and so-called the blue chip REITs, all become blue-black REITs. Why? They are worse than the risk index. What do you mean by that? If you were to buy CFA, okay, the risk Singapore risk ETF, it performed better than the three Mapletree REITs over the past 5 years. And this total return. Of course, STI is a runaway lah. Okay, now no need to talk about that. We are comparing risk to risk. And you see, I say that when you want to buy a ETF, risk ETF, you buy a risk that's better performing than a risk ETF, you make better return. These three risks, unfortunately, over the past 5 years, they perform worse than the risk index. Okay, and let's look at the past 1 year. You can see that Mapletree Pan Asia, as I mentioned recently, they got a good run. Okay, they outperform the risk index. So is China coming back? That's for you and me to guess. Is China coming back? The share price have been going up despite their negative news on the festival walk, or is it the worst already over for them? Current rental reversion is the worst part for them. Everything is worse already, cannot be go worse already. This is why the share price go up. And in the Mapletree Industrial Trust and Mapletree Logistics Trust is still underperform the risk index for the past 12 months. So who is a better bet now? Or all three are not supposed to invest at this juncture? I cannot make any comment on this. It's for you to look at it. And a disclaimer, I have all three. And I didn't add any of these three. And I didn't add any of these three for my client also. So that is, in fact, I buy other REITs, I add other REITs for my client and myself. But for these three, I just stay put at it is. I didn't add, I didn't sell. I just stay put because I feel that these three REITs will be there for the long haul. Will not go bust, will not gone. It's just that they need to ride the wave. They will need to ride the wave on that. Okay, but if you say that you die want to buy any of these three REITs, then you ask me which one will be the better bet. If you are negative on China, then buy Mapletree Industrial Trust. Positive on data center, might be better. Yeah, positive on China. then maybe Mapletree North Asia Commercial Trust may be a better bet because they got more weightage. But I say that you want to do in between, then Mapletree or Asia Trust will be the e-commerce play. So depend on what you stand. So there's no right or wrong. Only time will tell who is right, who is wrong. 5 years later. Okay. So that is on these three REITs aspect. And if you want to know more on how I look at REITs and how I analyze REITs, how I interpret REITs, I got the risk analysis course, okay, which will be run in August, where I got 14 hours to share with you on my insight and how I look at individual risks and what are the parameters and different way I look at it differently on basic aspect. You can attend this risk analysis course, which is purely conducted by me. And I will, first part will talk about risk fundamental, the basic of risk, what is it? But the second part, which is the most important, I would look at how I look at risk, how I analyze risk, my view on every risk. So from this, I will try to talk about all the 30 over risks in the course as an example. And okay, the positive and negative side. For that course, I can talk about positive and negative side. Okay, because it's a closed session also. A public webinar, I cannot talk bad about other people. But that one not talk bad, just talk about negative aspect. We will talk about dividend and the sponsor. We'll talk about that profile. I show you what do you mean by good and bad. I talk about ratios. What do you mean by good and bad ratio? I will use live example, not use hypothetical example, give you real example on that. And I show you how they do fundraising. What is a good way of doing fundraising? What is a bad way of doing fundraising? And by looking at the way they do fundraising, you know that is this REIT investable or not? And then you need to know how are they being charged a fee? Is it fair to you? And after that, all the parametric come in, you need to know what is the fair values, what is the best price to buy the REITs, or what's the best price to exit the REITs. But this is just the numbers within fundamental. We will need to aim technical. You see, technical fundamental put together, and you will make a better entry and exit on the REITs aspect. And then of course we look at really case study. And finish all this analysis, we'll look at how to build a portfolios. Some of them say, Darren, I just want ETF and unit trust. Can we do that? Yes, can look at ETF and unit trust aspect. But ultimately, we look at how to do a portfolios aspect. I'll share with you. Actually, I will just name the REITs you should buy in the course aspect and why, how we make that portfolio. But ultimately, you are the one that make the call. I'll share with you why buy this REIT for this purpose, why buy the REIT for this purpose, and how should they allocate the risk in percentage. But it's still your choice, your call. And of course, I got Excel spreadsheet with all the risk data there, updated one, so that easy for you to do comparison, for you to make a portfolio of that. Okay. And this will be the cost on top. On top of that, I will have another special 4-hour webinars out of the cost date will be maybe some way, I have not decided the date yet. Maybe somewhere in November or September, that will depends. We'll talk about US market. We'll talk about US REITs and US ETF. On this aspect, if you may, so those that follow my YouTube, you know that I got US REITs and Singapore REITs. I take them as a one portfolio as a whole to complement one another. I do not have hospitality REITs for Singapore, but I have US, I have VG properties to complement the hospitality I don't have in Singapore context. Because I don't buy any of the hospitality REITs in Singapore, I go and buy US one to complement one another. So I use that as a complement on one another. So we will talk about that. And then we got a special session just to talk about anything you can ask me about REITs. But during the 14-hour, I may not be able to answer all the questions. So we got a separate session. After the course finish, you digest it, you analyze it, then you come and ask me some more. So that will be more of a follow-up session on that. So you are keen on this, and do take this optional. It's not compulsory on that. So you are keen to sign this course. This is the date. Will be 2 weekday nights and 1 Saturday full day. The cost fee is 1620. And you are below 40 years old, you need to pay 870. But you are above 40 years old, you only need to come out 570. If your skill future credit is there, you can use your skill future credit to pay for the course fee. Okay. So that is on this course. Anyone that has seen that can sign a QR code on this. And if not, maybe you got Andy Andy to help some of the question. Andy, are you there?
Yes, Darren, I'm here. Can see me and hear me well?
Yes, yes.
Okay, thank you very much, Darren. Thank you very much also for those who are staying on to the end of the session. Like I say in the opening speech that yes, I think Darren also did mention. Well, this is in fact this will be our second last course preferably, right? For the year of 2025, which is I think we all know now we already stepping into the second week of the August. Now, yep, of course, we also want all of you here to benefit from the subsidy that what we have right now. So again, also let me just pull a little bit of history to share all of you here, especially those who have been go through the class lifetime income mastery course with us before a few years back, or whether even before the subsidy. I think why I say that because I always want to bring the history, the historical to share with all of you here. So remember I mentioned about Darren is very great on this personal finance and retirement planning. Now that course itself, lifetime income mastery, is mainly talking about that. So those are the time now I will talking about those who basically will benefit a lot. As in, why I say that because you can get up to 95% subsidy. So those who have been attended already, went through already, but basically, you know what I'm talking about, because you only pay, hardly you pay maybe 5% or even less 10% for course fee. But now, this subsidy also same from IBF. The video I play in the opening speech, Institute Banking and Finance, in short IBF, is carried out by MAS, Monetary Authority of Singapore, who are taking care, who are monitoring all the regulatory for all the financial institution, a stockbroker, or even let's say Darren also as a financial services director, their licensing all actually managed, also issued by MAS also, right? So this funding support come in place is like it's not an easy thing to just like that. As I said, because you remember I mentioned to all of you here in the opening speech, Cybercode, we actually gathered one of the highest number of IBF accredited courses. Just a B2C alone, on the B2C, which is on the retail level, we have easily more than 10 courses. So on the B2B side, on those corporate, they say CPT courses for those who want to get license, renew, right? I think you are joining in, I'm talking about. Last time they call CEP course, now they call CPT course. Those also a requirement. IBF module, in fact, Cybercode, we also garner one of the highest number also in the market in Singapore context itself. So of course, now to just share with all of you here, with this subsidy come in place, and also particularly right now, we still enjoy the 70% cost fee subsidy. So as you can look at the screen right now, the full cost fee is about 1,620. Sorry, it should be 1,635. Apology, because with 9% GST. So Darren, let me just share my screen. Yeah, so maybe I forgot to ask Darren to update on that. So this one, let me just share my screen. Okay, now this is the one that you need to take charge. As in, why I say that? Because if you don't take charge, right? Yeah, I believe you saw that. Let me just want to see. Okay, so I apologize. That one, it should be the fee as what you can see right now. Let me just put it into a full slide. Okay, and also as I said, I also want to take chance to run through with all of you here, and especially for those who are not familiar with Skill Future Credit. Just stay on for the next 3 to 5 minutes here, because I am going to run through, as in I'm going to sign in with my personal Skill Future Credit account. And then I go through the step by step for those who are first timer who get to know or want to use the Skill Future Credit to claim. I mean for Singapore citizens, because the Skill Future Credit is only for Singapore citizens, right? So if you're PR, as what you can see the slide right now, so the full cost fee is 1,635 with GST. So just now you saw the 1,620 because that one's 7% GST. So the cost fee is still the same at 1,005. So with the 9% GST, it will become up to 1,635. Now, of course, you may start to ask, Andy, online class, I join in, I am a non-citizen, I'm also a non-PR. How can I still participate the course or not? So my answer to you is yes. So let's say today, if you join the webinar session, if you're non-citizen and not PR, but of course you so keen, you just want to learn from Darren on this risk analysis course, then you pay the full course fee, because the full fee with the tax, with the goods and service tax is 1,635, and then on top of that, bear it in mind, the training material, the training guide, it will be in hard copy. We can even deliver and courier to your overseas address. I mean, I'm talking for those who are overseas. Of course, mainly most of you are local citizen or PR, then you should fall under either the 885 or 585. Okay, so to just open up to all of you to let you know that the good news is this class is online, and that's the reason why where it's online, we have a flexible to join the class. You need not to come to the training place, right? So it's a very convenient for all of you here to join for the class itself. So we are looking to the date. So as today we are stepping into the middle, in fact almost mid of this August, on the 12th of August already. So the date is on the 27th. So you are looking at say less than 2 weeks from now. Okay, about exactly 2 weeks from now. So it's on the 2 weekday evening, right? 27 and 29 August. These 2 dates will be on the weekday evening, 7 p.m. to 10:30 p.m. And then the last date of the class will be 30th August, and that will be 9 a.m. to 5 p.m. So it's a consists of three days, of which 2 days is an evening session, and then one last day is the what do you call it, this full day training session on Saturday, right? So it's an IBF course. Yep, for those who are first time to get to know about IBF course, then of course you need to let me just highlight. You need to have a certain requirement, as in you need to have a PC, laptop, and especially the PC laptop you also join in also at the same time you're able to view to see we're able to see you, right? As right now I can see you can see me, or you can see Darren for the last 1.5 hours. So we need that we need the webcam to be turned on throughout the training section, except the lunch break or the tea break. Okay, so there's a requirement. Then of course you need to complete all the 3 day session, 2 evening and 1 Saturday full day session. Then on top of that, the last day of the session there will be some assessment, right, to ensure all of you here uh, pay attention to. Now also let me just highlight to all of you here, the assessment is pretty easy assessment, right? So as in how should I say, it's a form of to ensure that all the trainees, right, the course participant, the trainees, go through the session. They don't miss out the session, and then it will be the so-called it's about an hour time that the assessment question will be in MCQ, multiple choice questions, and then it will be shared with all the trainees, course participant. So during the last day of the session, which is on 30th August, on Saturday, one of the hours about 3:30 to 4:30 will be a assessment. Okay, so that is actually to ensure that all of the course trainee you are following through, you go through the session. Okay, so if you are fall under the citizen below 40 years old or permanent resident, right? Of course, when we're talking about regardless of age, you need to be minimum 18 years of the legal age, right, to join for the class. And of course, you also need to be physically based in Singapore. Then you're eligible 50% IBF grant, the subsidy 750. So this IBF grant is a pre-funded model. So you are not going to worry that you need to apply to IBF. No, not necessary. So as long that you fall under this category, this 50% IBF grant, it will be pre-settled for you already. You only need to take care of the remaining 50% with GST, which is 885, right? Of course, you have SkillsFuture credit. You can use SkillsFuture credit to fund. Okay, citizen age 40 years and above, then you can even get higher IBF grant up to 70%. I mean, as in a full fee out of the 100%, you get 70% subsidy, which is 1050, and then the remaining 30% with GST 585 is a cost fee payable. Of course, as what I mentioned, if you're a citizen, then you can use your citizen so-called this SkillsFuture credit to fund for this credit. Okay, now let me just I mean, of course, for those who know how to register, please go ahead. You just scan the QR code, or if not, you just mouse over to the chat. In fact, I think let me just show to you here. I go to a chat, right? You see there's a risk analysis course, right? Just click on this. Once you click on this idea, right, it will come up to this thing. There is a form, right? Something like this. Okay. So it's an online class, so therefore we need to gather all your personal particulars. So yeah, when you click on the link under risk analysis course, right? Okay, of course, for those who want to use SkillsFuture credit, make sure you click the to register first, so as we can capture your particulars. Okay, so I click on the link, you'll come to this title, the purple color strap CQLMS. Underneath, you can see the course name, Real Estate Investment Trust. So in short, it's called REITs. REITs analysis course, and then the course time or so-called the date is already preset there for you already. Okay. Then what you need to do here is you just fill up under the detail applicants. So as you can see, the total close to 10 fillable field, right? And most of field is actually required compulsory field. Please fill it up. Okay. Once you fill it up already, then of course you preset as declaration. It's a self-paying participant. And then you move down here, you will do the sharing, the self-sponsored, or I mean, of course, some of you may say, how come this is company sponsored? If you used to have joining in today, if you're a training manager, you want your happen to be your company is a FI financial institution, you want to help your or those staff to upskill. Of course, it must be fall under the FI financial institution category. Then of course, then you can join the course under the company sponsor. But most of you today, you join is fall under the self-sponsored, which is the sharing I just shared with all of you, either it's A5 or 5. Then you move all the way down. You see under the final price, there's payment methods. So under the payment methods, you click on the drop-down list. There are total 3 payment modes, right? So the very first one on the top will be pay now. So pay now you link to your any of the retail bank, right? So of course you have to ensure you link created a pay now account lah in your retail bank, right? Any of your local bank, OCBC, DBS, or whichever. Now, of course, you also accept Visa or Master, especially for those who are non-citizen. Let's say if you're a PR, you do have SkillsFuture credit, you can use the Visa Master to make payment. And of course, if you're a citizen, you have SkillsFuture credit, that's where the SkillsFuture come in place. Okay, so these are the 3 payment method you can select. But prior to that, you need to make sure fill up all these required field. You fill up all those required field, especially with the asterisk. I think most of the fields are asterisk except for occupation. Then you have to select accordingly. Okay, let's say now I want to start off to using SkillsFuture. So I do a seamless process. Remember just now I mentioned to all of you there's a SkillsFuture payment. Okay, so you click the link. You see over here I just send the chat to everyone. Okay, there's a sharing to talk about different tier, and then of course under the first link called under SkillsFuture link, I click on that. So I click on the